I'm Mike Gitlin, and I wanted to welcome you to a new edition of Capital Ideas Podcast. And this is an opportunity really to get to know the people behind the money that's managed at Capital Group. You're going to get to know about them. You're going to get to know what makes them special, how they think of investing, the lessons they've learned during their career, who's mentored them. And I think you'll find it interesting. We're going to start with Rob Lovelace. Rob Lovelace is a global equity portfolio manager, and he's been at Capital Group nearly 40 years. He's a leader here at Capital, and he's a good friend of mine as well. And I'd like to welcome Rob to the show. Thank you.
Great to be here.
Rob, everyone at Capital, all 9,000 associates know you well, but can you take a brief minute and introduce yourself?
Sure. I'm Rob Lovelace. Started in Capital in 1985 as a mining analyst. I've been a portfolio manager for 30-ish years. I've been involved in management at the company and very involved in nonprofits, education, very focused on Los Angeles, father of two amazing young women, and happy to be here today.
A lot of folks know of the Capital system. And I want to talk a little bit about research and analysis because the Capital system is something that some folks have tried to replicate outside of our four walls. It's very hard to do. Tell me a little bit about how you would describe the Capital system to someone who didn't know it. Hey, we have this unique way in which we manage money. We think of it as a differentiator. Let me tell you how it works.
Well, it's not hypothetical, right? Because we're all trying to describe this all the time to people who don't know it. And if they're in the financial industry, what I would describe it as is that it sits in between the star system where there's one individual responsible for a portfolio and sort of a fund of fund where you're putting a bunch of stars together and blending them into one portfolio. If anything, though, I think it's closer to a fund-to-fund structure than it is the star manager structure. If at the core, you're beating the benchmark that you're trying to beat, and hopefully we're doing that, we're adding value through our fundamental research and through all the other pieces we're doing. If you can dampen that volatility, get rid of those down years in particular, but you will give up a little bit on the upside, but in so doing, you help people stay invested.
Right.
It's a much better system. There are all sorts of other things that fall off of that, though, which would include giving people individual responsibility within their portion of the portfolio and holding them to that and compensating them based on that turns out to be a really powerful principle. Because those that have copied us have often created team types of structures, but ultimately someone else has the responsibility for that slice, and that loss of responsibility changes how they invest.
Yeah, you need that accountability, that individual accountability.
It's both absolutely, and. So there's an accountability piece to it that matters, but I just think it has a psychological impact too. Knowing that it's you and you get to do, you sort of can't use any excuses. Sort of, well, I would have had great results if I'd been allowed to do this, but the main person didn't let me do that. And so over time, the way people learn their craft within the system feels different because they really are operating as independent investors with full responsibility and accountability.
So if you look behind you, there is a picture. Now, I can describe it or you can describe it, but you were in a bright green car. You have on...
Bright is an understatement.
Bright is an understatement. And the mustache is interesting.
Yeah,
I'm just going to leave it. Shocking is another word,
yeah.
Either way.
Yeah, ineffective.
So who are you with? What are you doing? Is this the definition of primary research? Tell me a little bit about this picture.
Well, it's not a primary color, but it is primary research.
Yep.
So it's David Fisher leaning over the car. Darcy Kopshow, our auto analyst and great friend, is in the passenger seat. I'm pretending to drive. It's a particularly bad mustache when viewed at this scale as well, I'm going to say.
You think it's just a scale?
It makes it worse.
It makes it worse.
It makes it worse. But I was, I know exactly the year because my wife in our first year of marriage encouraged me to try out the mustache, and it was shaved at the first anniversary. So
Okay,
I
so
gave,
what
I
year
gave it a
is
1
that?
year. So that's 1991.
1991.
Early 92.
Got it.
Yeah,
Okay.
so somewhere in there. You know, it's actually less about the car. I don't even know what model car it is, but the engine that it has in it is the key. It was called an orbital engine. It's a Hemi head top to the piston, so instead of the piston coming up on a flat surface, it was a dome, which gives you more surface contact and, in theory, more efficiency. It was a subsidiary of a mining company. I actually started covering it because BHP, an oil and mining company in Australia, had this. They had an R&D portfolio to diversify out, and I guess engines were close enough to oil and gas, so they figured that they would invest in it. But it was a technology that ultimately failed. May be used in some two-stroke engines. But the key piece that they got from it was actually the injectors. So to make it work, they had to design better injectors. So the whole fuel injection system that we all know was technology derived from this, but terrible investment,
Right.
for
Yeah,
sure.
I'm sure.
But you know, this is. And by the way, driving around in a car doesn't tell you anything that would have helped me know this was a terrible investment. All it told me was that the engine worked.
Right,
But,
which is really important to start with.
Yeah, we're at a parking lot of the Forum, by the way, where the Lakers played at the
okay.
time. That was the one area they could bring a car for us to drive around.
I love that. We have something we call the office treasure hunt. So we did go into your office, and we have a pile of rocks, and there's a reason for that. There's obviously a reason, and in your history, in your own education, rocks played a big role. And so that's why we went in your office without your permission and took them, and we're gonna have a little chat about that.
Thanks, Mike. I appreciate that you added rocks and roll together.
Boom. And they're in this little box here, and I'm gonna ask you to describe them very specifically. So I'll give them to you, and we have both listeners and viewers, and I'll hand them to you, and you can describe what you're looking at, and this is a test.
Well, the first thing I have in my hand is a stone, white stone. Luckily, it has written on it, Hishimari mine, although I would have remembered that anyway. It also has 120 grams of gold per ton, and it's from 1986, so the year after I started. We had a mining analyst named Hank Grunstead, and Hank went to this mine. I went with him but did not go underground. There aren't that many gold mines in places like Japan. It's a historic mine, but the key thing when you look at this fairly large stone, like it's the size of my entire hand, is you don't actually see any sparkles of gold in it. So this is actually disseminated gold, very small amounts. And I remember once with some friends out panning for gold, that after spending all day to get a few flakes in the bottom, you know, those little glass vials, my friend looked at me and said, I now understand why people fight over this stuff, because it's so hard to get. So this I actually keep in my office as a memory of my friend Hank, who was a real mentor to me when I started at Capital, but also just a reminder of why it's precious. Not only because of its physical qualities, but just because it's so hard to get.
That's great, thank you. And the other one, which is very heavy, by the way.
Yeah.
What do we have there?
So I think it's the base that's heavier than the stone. So the stone itself is mounted in this silver base. But when you see it, you get the whole rainbow of colors on it. And it's called peacock ore as a result. Not that rare. And it's a mix of copper and iron, which gives it that affect. And for those that know copper and iron, this is bronze. So it's, you know, the early people, when they found this, were probably attracted to the stone. Then when they melted it, they realized that they could get bronze out of it. So the Bronze Age, like this, ties you all the way back to that. But of course, they had to get to the point where they could get the heat hot enough to actually create it. But Mother Nature served bronze up to us. It wasn't someone somewhere that sort of figured out how to put the different elements together. You can tell by the fact that it's mounted on a base. It was a gift to me, as opposed to something that I pulled out on its own. I'm pretty sure this one's from Eastern Europe somewhere, and you know, reminds you of history.
Love it, thank you. And you passed the test, and one of the reasons that we did that, Rob's major at Princeton was mineral economics. So very well described. We'll give you a solid A, but very well described. But how does someone who majors in mineral economics become an investor? What's that switch that says, I'm going from rocks, minerals, that world, to the world of investing? What was it?
I always had the intention to be an investor. So when I went to college, I already knew I was interested in investing. I was already investing in my own portfolio. In fact, my first broker was the son of another capital associate. So, Value Line used to have these paper charts you could look in to do, what I thought was fundamental research, but of course it wasn't. But I was interested. And so I went to Princeton and started as an economics major. And economics at the time was very econometric, so it was focusing on how to use calculus to describe how people behave, and it was terrible. And the other thing that Princeton had then was a book had just been written by one of the key professors, A Random Walk Down Wall Street, that basically said markets were efficient, so active investing was a waste of time. Needless to say, neither of those were speaking to my soul of trying to understand and work with people. And I had taken a class called Resources of the Earth, taught by a very dynamic professor, and it was about oil and precious metals and all sorts of things that were really interesting. And back in the day, there was you didn't get grades online. There was a board posted, and where my grade was supposed to be was a little note that said, "See me." Right? So I was like, I'm in trouble. Right. I am in big trouble. So I go in and the professor said, "You're obviously interested in this subject matter." And I'm like, "Why is that so obvious?" He said, "You had the highest scores in the class. So why don't you become a geology major?" I told him the same story. "Well, I'm really interested in being an investor. I like people, and he said, "Oh, we have a department or a degree here called mineral economics. You can do as much economics as you want. You just have to do a minimum amount of geology." He said, "Based on what I'm seeing here, you're going to be just fine with that." That's what I ended up doing. I wrote a junior paper about the oil fields in Santa Barbara. By the time I graduated, I was all geology. I worked on volcanoes in the Canary Islands. At Princeton, you have to do a thesis. So I was much more of a geologist, but in the end, it turned out to be critical. And with the geology background, I was applying as a mining analyst. And so talking to mining companies, right? So, and ultimately, when I was hired as an intern at Capital, it was actually to do a project on gold and silver, supply and demand and pricing, and then started as a mining analyst.
That's a great story.
Yeah.
I love that.
Yeah.
Okay, Rob, even our brilliant analysts have some things that go awry. And obviously the goal is to learn from it, but tell us a story. Give us a story of something that didn't go as you would have hoped, and some of the people who might have walked the hallways thereafter to say, "This happens, you're good, keep moving forward."
Well, I mean, to be fair, we all have a lot. So it's hard to actually narrow it down to just one or two stories. Thank you for the memory on Orbital Engine. That was definitely not one of my prouder moments. But as a young analyst covering Mexico, so it was the middle of the peso crisis. I just picked up the country, and it was actually bouncing off the bottom. And the market was rising, and I had actually David Fisher, who was leaning in the car in my office, frequently saying, "When are you finally going to step up and buy something?" And I found it, which was a telephone equipment supplier called Ericsson from Sweden. And they were spinning out their Mexican subsidiary because the market was going up so much each day. And we literally bought it the day the bell rang of the top of the market. That's when the second or the primary
offer. You cornered the peak.
Nailed it.
Yep.
And it fell, I think, 70% on its own. And then the peso was devaluing at the same time. So if I remember, peak to trough was 90-ish%. And it began to recover, and then Ericsson came in and bought it back, but they were wondering why we were upset. They're like, "We paid you a 30% premium." And we're like, "Yeah, but you know the price you sold it to us at." So many lessons I learned from that relative to management, and they weren't doing anything unethical. In fact, they did the right economic thing for themselves, but they weren't great partners. And so, our interests weren't aligned, even though you might look at it and say you were. And, there are all these different pieces that come out of that.
Fair enough. So on the other side, there is, I wouldn't call it, because we're a humble culture, an investment superpower per se, but there is a differentiator, an edge you have that's repeatable, that you tend to do well as an investor? What's your edge? What's Rob Lovelace's edge in the market?
Well, the nice thing is that what I'm going to say is so obvious that it can't actually be something to brag about. So that's perfect, because my competitive advantage is time. It's just time. And we say we're a long-term investor.
Time horizon.
Well, I'll walk you through it.
Okay.
You tell me if you agree with my
Let's do it.
with my descriptor. But we definitely are trying to invest for the long term, all of us, and we achieve that. But I think our competitive advantage really does kick in as you push that time horizon, to your term, longer. And so I've got myself in a position now where in my portfolios I have an average holding period of about 8 years.
Wow.
But to achieve that, that means I've got some holdings that I've had for 20 years, like my entire time as a diversified manager in some of the different objectives. And because I have a lot of stuff that I'm only holding, I call them auditioning. They're auditioning for 3 to 5 years, right? Trying to see if they really have that.
Smaller positions to start to.
Yeah, absolutely. Because I don't know. I don't know in advance. I mean, and I just looked at a report of those companies that were kind of in the 18 plus, and it wasn't a list that I would have necessarily guessed ahead of time. You know, there's ASML, the manufacturer of the lithography that print the chips, so tied to the technology and computer boom. Novo Nordisk, a company fighting diabetes for many, many decades, but had a little bit of a hiccup there before they came back strong. Microsoft, which was one that actually owned and then didn't totally eliminate, but was a very small position. Nestle. It's a hodgepodge of companies, if you see what I mean. Like, it isn't all the drug stocks or all the this is or that. It's a really interesting mix of companies. And so it's the patience required to not be pushed into action. This is why time horizon isn't the whole story, because everything in our lives outside of work, and even in the office to an extent, the number one question we ask each other is, what are you doing? What are you doing? What are you doing? What are you doing in your portfolio? And to not do anything, I don't think we celebrate enough the not doing something.
Right.
We don't have entire calls saying, what are you not doing in your portfolio? And that's, to get to 8 years requires a lot of not doing.
What's interesting about that, I was chatting with one of the fixed income portfolio managers and asking him to take on responsibility in a non-investment way in some area. And I said, do you have capacity or time to do that? And he said, absolutely. And if I focus on that, it will take a little bit of the pressure of me feeling like I need to touch something in my portfolio, feeling like I need to touch something that probably doesn't need to be touched.
Exactly.
So that's part of the time. I get why you had that nuance in there.
There's more discipline required than just being patient too, because you have to constantly look at it and say, is this company still going to be that good for the next several years? Right. So you're constantly looking at it, auditioning. And then you have to not do anything.
Right.
That's a weird combination.
So you're a global investor, and in the last 15 years, my numbers won't be exact, but the S&P has done about 14% annualized over the last 15 years. Been a very strong period, obviously. And MSCI All Country World ex-US has done about half of that. What does the next 15 years hold? Is it a time to be a global investor, to get some non-dollar exposure, to find some great companies around the world? Where are we in that? And 700 basis points annualized over 15 years is meaningful. What does the future hold?
Well, it's a great question, but you've got to click down one into the stats to I think, get a better picture. So your number's absolutely right. 15 years, S&P or similar, compounding at about 15%, rest of the world 7 or 8%, depending on how you want to look at it. If you look just at the US over that time period, earnings growth has been pretty good too. So earnings growth has been about 7-ish% over that period. So the US market has had that kind of return, half because the companies have been growing and half because the multiple has expanded, in part because the companies have been growing. I say that because outside of the US, over the last 15 years, what's remarkable is that earnings growth outside the US has only been 1 or 2%. That's where the big delta has come from, which is there has been something very important and special that's been happening in the US with tech companies, with some of the pharmaceutical companies, that has created a special opportunity, which is why the US market's done better. And because of the continuity of that, people have been willing to pay more for it. So the question then about how this reverses, is there going to be regression to the mean, has much more to do with what does earnings growth look like outside the US. There's one country that has actually been able to achieve earnings growth similar to the US. I could ask you to guess, you won't get it, because it's Japan.
Which has done remarkably well in the last couple of years.
But before that,
it had a very long period of time where it didn't.
Where it was because people were worried about deflation. Right. And so that earnings growth in Japan didn't just start. What has just started is people realizing that even through that deflationary period, Japanese companies were able to grow.
Right.
They're now starting to get what the US got, which is, if you can consistently deliver results, we are willing to pay more for that. That's where Japan has started to rise. Europe, over the last 2 decades, has systematically done what Japan had done before that, which is hollow itself out. So Europe has been shifting its markets essentially to China and to the United States. So investing in Europe right now is a proxy for those two areas. China has had great economic growth, but very poor corporate earnings growth. So whatever's been happening, for lots of different reasons, has not found its way into the listed companies. That's why the Chinese market has been such a drag on emerging markets and such a drag in general on ex-US as it's gotten bigger now. Since Europe hooked so much of its wagon, if that's an investment term, to China, they're paying the price for that too. In other words, it's been helpful, but not enough to offset it. And to the extent that the US has been helpful to them, and so certain European pharmaceutical companies or others that do a lot of business here have seen the benefit. So it isn't like the countries really help you determine where to go. It has mattered more on the industry level and the company level. So what I always say to people is, I know we want to talk about countries. And I know it's an easy construct, and it makes sense, but because of how Europe has structured itself, you can't really invest in Europe anyway. It's way better to think about it at the company and the industry level than it is at the country level. One last stat for you.
No, please.
In the United Kingdom, in the FTSE index, more than 80% of the revenue of the companies listed on the FTSE come from outside of England.
Right.
So you can't really invest in England anymore. In Europe, if you look at the broad indices, 60% of the revenue comes from outside of Europe. So you're not investing in Europe when you invest in Europe. You're not investing in England when you buy the FTSE.
Right.
The US is down to about 65% being the US, but at least it's majority.
So you mentioned Japan, you mentioned China. Without talking about open orders today, your conviction, China from the macro, from some of the political stuff going around the world, China's had a really hard time, and Japan's taken off in the last, 18 months. Mm-hmm. Where are you finding value? Or is China cheap enough to be interesting to you? And is Japan run so far so quickly that you're a little bit concerned, even with your long-term time horizon, that valuations are getting stretched? Where's your portfolio mindset today?
So again, one of the key places to start is geography is only going to tell you headwind or tailwind. It's not actually going to tell you where you want to invest. And I think one of the key things people need to get their head around is everything we do is global investing. There is really very little regional or country investing possible anymore. So if everything is a global portfolio, give your manager the flexibility to buy the best companies. Don't limit it to geography. Right. To your question though, I'll just do headwind and tailwind. Japan has a tailwind because it's being recognized as a country where the companies are able to generate good earnings. So you probably have multiple expansion coming your way, and there are companies that are doing great things, which is why we're seeing the earnings growth. Japan has a tailwind. China, big headwinds, multiple. China's intervention in its company's management and in its company's earnings, the listed companies, makes the entire country feel like a regulated industry. And regulated companies trade at a discount because they can't have those great big windfall years, and the government can get upset with them every once in a while and take something away. I just described China, except as a whole, but they haven't even told us what the rules are. And so they have demonstrated they're willing to step in if they think a company's earning too much profits, and simply ask them to give some of it back to the government or invest in companies they need them to invest in. They have demonstrated if they don't think a company management is operating the way they want them to, they will change the management. That is the definition of a regulated industry. So China has a headwind because people are just waking up to the fact that it should trade at a multiple discount. Opposite of Japan, multiple expansion, China, multiple discount. And interesting, even with all the economic growth we've seen in China, those numbers have not found their way into company profits. So both because the government has taken things back and the companies, I guess, have been reinvesting so much, but for whatever reason, that profitability has not found its way to the investor level. So overall, harder to find great opportunities in China, but never say never. That's why you got to go down to the company level. So headwinds in China, not to mention geopolitical, tailwinds in Japan, although it's a tough neighborhood. If things go wrong in China and Taiwan, Japan is not going to trade up on that news, right? Europe is in between because Europe's generally not overall growing a lot of earnings, but there are some great companies there. I've learned never to discount a region entirely. Find those great companies that are there. In the current sphere of investing, though, the U.S. is a majority of the opportunity set, and that's good for all of us.
Right.
But never miss that opportunity to be a global investor, because whether you like it or not, you're a global investor.
Yeah, and in some ways, just based on the dollar strength and the strength of the S&P, we almost have a generation of investors who have not been global investors.
Well, they have been, but through U.S. companies only.
U.S. companies
so
only.
They've limited their opportunity set.
Right, and it's a big world out there.
Right. I mean, and why limit yourself unnecessarily?
Right. Let's click up a level and talk about mentors in your career. Who had an impact on you? If someone still does, that's great as well. You've turned into the mentor, and you probably don't have a ton of mentors that are mentoring you today. But who helped you early on in your career that made a difference? And I'm sure the list is long, and I know I'm calling you out by asking you to pick one or two, but help me.
Well, no, it's fair to say the list is long, and we've also highlighted already the generosity of spirit that people have around here, and walking into your office and helping you when you're feeling down, and maybe even taking a little of the air out when you're feeling a little too good. So, it's a great culture that way, and you can definitely turn to lots of people. Look, it's an obvious one for me to say, but it's true that obviously John Lovelace was someone super important in my life. Maybe less of a mentor than some might assume, in the sense that he was super sensitive for both Jim and me, that it not appear that this was a foregone conclusion that we would be here, and he wanted us to demonstrate that we really stood on our own 2 feet. And I appreciated that more later in life than maybe I did at the moment. But I think a lot of us, especially at the portfolio management level, learned by watching him, and he was a patient investor.
And how many years did you and your father overlap working at Capital Group?
Well, he retired in the mid-2000s, so 20 years.
So 20 years, yeah.
Yeah, 20 years. And I'm going to say it, when I was an analyst, I think there was very little interaction.
Right.
Which again, I think was sort of a nice gift that he gave me. So, I could build the confidence, and as much as he tried to dispel it, everyone's going to assume that somehow, there's an advantage that comes to that. And I'm not going to pretend that sword doesn't cut both ways, but it was really more watching him as a portfolio manager that I'd say I got some of the lessons that I'm still sort of, thinking about and applying today. Very soft-spoken guy, and that seems the thing about a lot of the mentors is sort of how soft-spoken. There was a man named Thierry Van Deventer who was very close friends with John, and he's actually the one that he used Nestle, which is one of my career-long holdings, sort of took me to school on that one holding and basically saying, what is Nestle? And back at the time, it was a coffee company, right? And he's like, no. Obviously it is. And he said, no, watch. And what Nestle does systematically is it doesn't have to be early, doesn't rush into it, waits till these trends identify themselves, and then they can actually go in and slightly overpay for buying brands and building water, building pet food.
Then they own the brand.
Yeah, pet food is like 30% of it's like the number 2 division. And if you ask anyone, even today, like, hey, Nestle, what's their number 2 area? No one's going to be like pets.
Right.
But what they did is they come in late, but the reason they can turn it into something, even if they overpay, is because they're so global. They can take whatever that is in the US and run it across the world and deal with different preferences.
Distribution network, brand.
The whole thing.
Yeah.
And so that's what it is. That's what that company is. It isn't the thing company, it's the concept company. And learning that from him was oh, right, because now I'm not spending all my time thinking about what coffee trends are. And the stock will trade up and down. Well, coffee, there's a short crisis in Africa because the disease is spreading through. We've got to sell our Nestle. And it's like, what? Like, this is a pet food company.
It's a much more diversified company than that.
Yeah, and they're going to find the next thing. And, if water goes out of favor, they slowly trade out. So, but if you see what I mean, like that lesson in one stock changed my life as an investor.
And you're a long-term holder of Nestle.
Yeah, I've owned it since I started because of Thierry.
Wow. So, Rob, we're going to finish up, and it's a moment where I'm calling it an obsessively grateful moment. But someone did before me, and I'm going to share with you a present that I want to give you. But I feel as if gratitude is an important thing. And it's something we don't have enough of in general, people. And so tell me something personally, professionally, what are you grateful for?
I'm actually pretty shy. I know most people don't believe that when I say it, but I'm like an introvert that loves people. And so, like it wears me out, but I can't get enough of it. And so I'm so grateful to be able to work at a place like Capital, which has so many amazing people, almost as quirky as me, and right, so we can be awkward together and involved in this endeavor, right, which helps people have great lives, right? If we're successful at what we're trying to do in terms of taking people's money and giving them back more of it when they need it, so that they can have that wedding or pay for the medical bill, whatever. We don't get to decide what it is. But so sort of this highly rewarding profession with great people, making the world a better place, and the opportunity to then also give back because of that. And another thing that I spend a lot of time and energy on, like you don't write a better script than that.
Yeah, you don't. Thank you for sharing that. I will tell you, as I share with you a mug that says, "Be obsessively grateful."
Oh, okay.
So thank you.
Thank you.
But I wanted to tell you as we finish up.
I'm going to do my Vanna White.
That's the mug.
There we go.
But I wanted to tell you that, and I don't want to make you feel awkward, but I'm willing to.
Too late.
I'm grateful for you. So the fact that and we've had this scheduled for a while, the fact that you're able to come in and have this session and this podcast shortly after your mother passed away, you didn't have to come in and do this, and we appreciate it. And I'm also grateful for you. You've been here almost 39 years. You've had a huge impact on Capital Group. You've had a huge impact on me personally as a mentor and an advisor. And you've had an impact, you mentioned it at the end, just on people's lives. That's what we do. We exist for our clients. And you've had a meaningful impact on everyone who's worked at our company and the tens of millions of people that we've served over decades. So I am grateful for you. Thank you for being our first guest. Thank you for being my friend. We have a great monthly series planned for you, so please subscribe to Capital Group on YouTube or wherever you get your podcasts. And we'll see you next time around.